The preferred share market, traditionally seen to be a more stable cousin of the common share market, has had quite the year. While common shares have moved up, preferreds have dropped sharply, specifically the Rate Reset Preferred Shares. Here to give us some perspective on the sell-off and what is happening, I'm joined by Scott Booth. Wow, it has been an interesting year for the preferred market.
Certainly has.
Yeah, so let's, preferreds, just for the uninitiated, these are vehicles that have a higher claim on assets than common shares. They yield more, they have no voting interest. Traditionally, their dividends are paid before common, so that's what the structure is. But the Rate Reset Preferred Share, tell us a bit about that.
Well, I mean, it's like a traditional preferred share, except that it's got a dividend that'll reset every 5 years.
Right, versus the other perpetuals, which just pay...
Dividends are fixed for life.
Okay, how are these reset?
They'll reset at a given spread over the Government of Canada 5-year rate. Generally, when they're issued, let's just say you issue a Rate Reset Preferred Share with a 4% dividend. If at the time of issue, the Government of Canada 5-year rate's 2%, then you'll end up with an issue with a reset spread of 2%.
Okay, these became popular about 7, 8 years ago because people were they trying to protect themselves against rising rates?
Yeah, that was the impetus, I guess, for their first origination, was because of concerns about rising rates and investors wanting some protective mechanism against that.
Right, and so the idea being that if they're concerned about rates being low 7 or 8 years ago, when rates went up, they would be able to catch some of that upside. That is not what happened.
That is not what happened.
So what happened? Tell me a bit about the sell-off, what we've seen, and perhaps the discrepancy you're seeing in valuation.
Sure thing. Well, I mean, when you look at the sell-off, I think it was really catalyzed by the Bank of Canada's decision to cut rates at the beginning of the year. That really sparked this most recent leg down. When you look at valuations, we've got a market that, in our view, is discounting as though Government of Canada 5-year rates are here to stay for a very, very long time. You're seeing a lot of rate reset issues that are trading at $6, $7, $8, $9, $10 discounts to par value.
And these are $25 par value.
The $25 par value issues. And really, when you look at it in terms of cash flow, and this is the part of the math that doesn't really make sense to us. Let's just say you got a preferred share with a $25 par value. Let's just say the dividend resets at 200 basis points below what market value is. That translates over 5 years to a difference in cash flow of about $2.50.
Versus a $7, $8
versus
sell-off.
a $7 or $8 sell-off. And so to me, that's the market telling me that my view on interest rates is that the rates will be down here for a very, very long time. And while I'm not of the view that rates are going to increase dramatically in the near term, or even in the next couple years,
right.
I'm not of the view that there's no longer a cycled interest rates and that this is Japan and we're bound for zero from now until the end of time.
Right.
Which seems to be what the market's indicating.
But some could even say at these levels, we could see the Bank of Canada cut again, and wouldn't that would impact again?
Sure, it would. But again, let's just say, let's call the 0% as a floor for the Bank of Canada.
Yeah.
Even so, that's a 50 basis point decrease from where we are today. 50 basis points on a $25 par value translates into 12.5 cents a year. So over 5 years, you're looking at 62.5 cents, and then you got to present value that, and so I mean, really, I think you're seeing a market that's responding with moves that are much more significant than the actual reductions in cash flow that are going on out there.
Okay, so great explanation. Let me ask you, if you're in one of two camps if you're watching this video. You've either don't hold preferreds, maybe you've never really paid attention to them or heard of them, or you hold them and you're probably not in the best of humor right now given what's been going on. Let's start with the folks though that don't know about or just have not had preferreds as part of their portfolio. What's the opportunity here, do you think?
I think it's a very good opportunity to add exposures here. I mean, I think when you look at the options open to income-seeking investors, there's very few that will pay you something a reasonable return and give you protection in a rising rate environment. And when you look at the discounted rate in the rate reset market, those are issues where, I think you can if you look at the universe now, about 65% of it, if it reset tomorrow, would yield you north of 4%. On top of that, this stuff is trading at big discounts to par value. And what that means is that there's not much call risk associated with it. So if
Call being they would bring them back.
They could call them back.
Yeah.
And what the benefit of that is that there's lots of upside or runway should rates ever rise. And if rates rise, I think the return picture on these, it becomes much more of a total return instrument, because you'll likely to get a very nice dividend out of this stuff to start off with, and on top of that, there's that potential for capital appreciation piece. And I don't know how long it takes for interest rates to rise. I don't know if it's 2 years, 5 years, 7 years.
Yeah.
But I think if you're getting compensated and paid to wait, if you believe that that's an eventuality, then this is a very attractive asset class.
Let me ask you, can you just take us through an example? I know you brought a few here, but just take us through one, just walk through a quick scenario, if you would, on one of these names.
Sure thing. So we'll start at the top of the list here. Enbridge Inc. This is a name that's been very beat up, and looking at the C series of preferred, or enb.pf.c, currently trading at a little over $18 at a running yield of about north of 6%. Now it's got a fixed dividend until March of 2020. So
5 years from now, yes.
So better part of 5 years from now.
Yeah.
And so if you're buying it today, you're essentially, assuming it continues to pay a dividend, locking in a yield north of 6% for the next 5 years. And in March of 2020, the dividend on it's likely to reset. I wouldn't be anticipating call on this one. But let's just say we get out to March of 2020, and Government of Canada 5-year yield sitting at 50 basis points, 30 basis points below where we are today. This would reset and pay you about 4.31% or 4.3%. Now, if Government of Canada yields tick up to 1.5%, then the dividend on this would reset and it would pay you about 5.7%. And so on and so forth. So we think that you don't really need a dramatic increase in Government of Canada yields for these to be appealing investments from a cash flow generation perspective.
Let me ask you then, so that's for the group perhaps who see the opportunity that don't hold those. For those who have been holding these and been hoping for that raising rate environment hasn't happened, what would you suggest for them, and what options are available to them?
Well, I think that when we look at it, we'd either be adding more exposure. If you don't have the capacity to do that, I think you either hold or make a switch to harvested tax loss, and that last option would be our preference here.
So sell off something, get the tax loss, reinvest it in a higher quality name? Or?
Yeah, in the space generally, and I think you can either look to improve credit quality, extend term, take a couple bucks off the table, maybe go from something that's trading at $16 to something that's trading at $14. I think there's lots of different potential motivations there, and depending on the characteristics of that investors are looking for that reinvestment option, there's a ton of choices, because this really hasn't been a company-specific event thing. It's a broad market event, right? So there's a lot of issues that have been similarly impacted. And really, when you look at Catalyst, it just seems to be it's a low Government of Canada 5-year yield.
Great information, Scott. Thanks so much.
Cheers.
Scott Booth, Portfolio Manager at TD Wealth. I'm Kim Parlee. Thanks so much for watching.